Hi guys, I hope you all are doing very well. Guys, in this video, I'm going to tell you about a topic. The name of the topic is financial leverage, and this topic is the most important topic that every finance guy, every finance student should know. Why? Let me tell you why this topic is very important for all. And in this video, I'm going to clear each and every aspect of this topic, and it will help you a lot in your future. How? See. So this is you, and you are studying right now. So after completing your studies, there will be three options that you will be choosing. Either you will go for job, either you will start your own practice, or you will start your own business. So these are the three options. There is no other option. Fourth option is like you will sit at your home, which is not right. Why you are studying if you want to sit at your home? So as a student, after you complete your studies, you will be doing job. You might be doing your own practice. You might be starting your own business. So this concept, financial leverage, might be required in all three options that you have. So first is, in case if you're doing a job and you work for a financial company, so in that case you might need to know this topic. It will be expected from you that you should know about this topic in detail. If you are doing your own practice, then you might need to help your clients in this financial leverage. And if you are starting your own business, then in that case also, in your business, you will have to use this concept. So what this concept is, let me give you an example. So this is a person, he has planned to start a business. Okay. And for that business, he needs an investment of 1 crore rupees, or you can say $1 crore. So for all the students who are watching this video from outside the country, you can assume it to be $1 crore. And for all the students who are in India, you can assume it to be 1 crore rupees. So there's a person who want to start a business, and the investment requirement in that business is 1 crore. He has 1 crore rupees. No, there's nothing that is don't have 1 crore rupees. And after the extensive research, after a lot of planning, after a lot of valuations, he came to know that the return on investment of this business would be 15% per annum. That means once he put money into this business, 1 crore rupees, he will get approximate of 15 lakh rupees per annum from the business. So this is not something that he came to know from just a normal studies. He has done extensive studies on these, like valuation, acquisitions, different businesses who are working into the same field, industrial rate, everything he has checked, and he has come to a conclusion that the return on investment of this project would be 15% per annum. That means once he put 1 crore into the business, purchase machinery, purchase stock, start the business, he will earn an approximate of 15 lakh per annum from this business. And as I said, that he already has 1 crore rupees in hand. So in pocket, his own pockets, he has 1 crore rupees. So the point is, if we go by traditional methods where people used to think that let's not take any loan from any bank, whatever money we have, we put that money into the business and we start the business, because it will going to be very less risky. So in case if there are losses, so we don't have to pay any interest to the bank, and there is no fixed amount that is required to be paid through us. So this is a traditional approach that if you have 1 crore rupees, put that money into the business and start enjoying the return on investment that you will get from this business. So this is a traditional approach. On the other hand, he has an option to take loan from bank. Although he has money, but he has the option that he can take loan from bank, same amount, 1 crore rupees. And if we take loan from the bank, then he have to pay an interest of 10% per annum. So as I said, there are two options. One is to put money from his own pocket, and second is to take loan from the bank and put that money into the business. So as per the traditional approach, people will take the money out of the pocket and start doing the business, because that is less risky, what they feel. But here financial leverage terms comes, which will tell you eventually, if you follow this, if you work on this, you will get higher returns than this. So how is this possible? Let me tell you. So if he do not invest money from his own pocket, okay, and he take loan from bank and he put that money into the business. So he take loan from the bank and he put that money into the business, then what will happen? So his return on investment, as we know, is 15%. So for 1 crore he will get 15% per annum, so he will earn 15 lakh rupees. As he has taken loan from bank for 1 crore, he has to pay interest to the bank as well. So 1 crore into 10%, that is 10 lakh. So ultimately he will receive only 5 lakh rupees. So if he take loan from bank and invest the money into the business, so we can see that he will get approximate 5 lakh rupees in his pocket. So you might feel, sir, earlier he was getting 15 lakh per annum, now he is getting 5 lakh per annum, so this is not a benefit. So financial leverage is not a good thing. But I would say in that case, he still have this 1 crore in his pocket. He have this 1 crore, he has not invested this money into the business, he has this money in his pocket, he can put this money anywhere else as well. So let's take an example. If he invests this money in mutual funds, in which he know that he can get approximate 12 to 15% per annum return. He know that in mutual funds he can get 12 to 15% per annum return, or he can choose to start another business in which there is a good return as well. So if he, just an example, if he take mutual funds for that amount and let's say he earned 13 lakh rupees from that. If we invest money in the mutual funds, he will earn 13 lakh rupees. So 13 lakh rupees he has earned from the amount that he has. 5 lakh he has earned from the business that he is doing, but he has not invested anything. So in total, he has earned 18 lakh rupees. So this is one of the benefit of financial leverage. So what financial leverage is? Financial leverage means that rather than putting money from your own pocket, we should take loan from the bank, which is called debt. We should take debt and invest that money into the business. It will give us higher return. I will tell you this technically as well. This is logical reasoning. I will tell you very technically as by giving examples as well how financial leverage works and how it is beneficial to the shareholders or owner of the company. So one of the benefit, as I said, is, listen very carefully. One of the benefit he will get is he will get higher return. First thing. Second, he still has this 1 crore in his pocket. This money will belong to him. And thirdly, after certain period, this business, this investment, he will also own this investment, because let's say the loan is for 10 years or 12 years, he repay the loan, then definitely this business will also be going to be his business. So he is getting a lot of benefits. He is getting, like we can say, overall he is getting 5 lakh without even putting a single penny from his pocket. From his money, he is getting a good return. He is getting total return. He has this money in his pocket. So that's all. Those are the financial benefits of the financial leverage. Another good, so another benefit of financial leverage is, I'll tell you, see, this is from the taxation point of view. So if he is getting, let's say, if he put the money from his own pocket, he is getting 15 lakh rupees. Okay. And if he's taking loan from bank, he's getting 5 lakh rupees in his pocket after paying interest. Okay. So this is one of the benefit. Second, of course, benefit here is higher, but we are not counting this as well, because if we count this, he is getting a better return if we take loan from the bank. Secondly, the interest that he is paying, 10 lakh rupees interest, this is tax deductible. So interest is tax deductible. What does this means? Tax deductible interest in tax deductible means. So see, if he has put money from his own pocket, there is no benefit of interest, no interest. He don't have to pay any interest. So in that case, let us assume that the tax that he need to pay to the government is 30%. Okay, so 30% whatever he earns, he has to pay to the government. So if he has earned 15 lakh rupees and he has not paid any interest, that means on this 15 lakh, 30%, that means 4 lakh 50,000 is the tax that he has to pay to the government, and ultimately he will get 10 lakh 50,000. He will earn 10 lakh 50,000 because he has to pay 30% tax to the government. So 15 lakh minus 30%, it is 10 lakh 50,000. So here he has to pay tax 4 lakh 50,000. In this case, how much tax he need to pay? He need to pay tax on 5 lakh. So 5 lakh 30%, it is 1 lakh 50,000. So here he need to pay tax 1 lakh 50,000. Here he need to pay tax 4 lakh 50,000. So one of the benefit that he's getting for the interest is he has paid interest of 10 lakh in this case, but out of that 10 lakh, he has saved 3 lakh of the interest because this interest has saved his 3 lakh tax. Again, you will feel that, sir, you are wrong, because in this case, he's still earning 10 lakh rupees. And in this case, he's earning 3 lakh 50 rupees, 3 lakh 50,000 rupees. Yes, you are right. But still you have missed this thing that he has 1 crore rupees in his hand, and definitely he will not put that money idle. He will use that money somewhere from where he can get some good returns. So this is also the amount that he will earn as well. So if we talk about the total benefit of financial leverage, so one of the benefit is that you get a better return because the interest rate is higher. Sorry, interest rate is not higher because the interest is tax deductible. Whatever interest you pay, you get a tax benefit of that. You still have the money. You don't have to, you have not invested the money into the business. That means you still have the money with you. And third, and the most important is, this is your business. You can do the business by yourself, because even if you have taken loan from bank will not interrupt you in between the work. You have to do the business. If you get very good returns from the business, your profit might increase and you have not put a single penny from your pocket into the business. So this is a layman understanding of financial leverage. So now let me go on the technical part, and with giving the example, I'll tell you how financial leverage is a better option and it's a very good thing to follow in future. So all the students who are watching this video, you can use this thing in your studies. You can, once you become a ACCA or a chartered accountant or CFA or CPA, whatever degree you are pursuing, you can use this for your clients. Or if you plan to start your own business, because a lot of students nowadays are planning to be entrepreneurs, so you can use this for your business as well. So let me give you a practical example how financial leverage is going to help you. So once again, what financial leverage term says? So financial leverage says that rather than putting money from your own pocket, that is equity, take debt or loan and invest that money into the business. Okay, but this concept will only be profitable in cases where the return on investments is higher than the interest rate. So where the return on investment, like in the example I gave, was 15% and the interest rate was 10%, only in that case, this method will be profitable. If there is a scenario that the return on investment is less than the interest rate, so in that case, the more equity you will put, it will be a better option. Don't worry, I'll give you an example, practical example, from where you will understand the concept fully. So what does this means? So if the ROI of the project is more than the interest rate, higher debt portion would be a better option. And if the ROI of the project is less than the interest rate, in that case, higher equity portion would be a better option. So let me give you a case, or let me give an example from where you can understand this concept fully. And I'm very sure that after this video, this concept is going to be, you will not going to forget this concept anytime. And in case if you do, you can watch this video once again. So you can like my video, you can share my video with your friends and knowns. And yeah, let's read the next part, the practical case. So the first example is, suppose you are planning to start a business which requires rupees 30 lakh as an investment from you. Okay. First case is that return on investment is 13.33%. You know that when you invest money into the business, you will get 13.33% return, and the bank loan rate is 10%. So if you take loan from the bank, if you take debt, you have to pay a 10% interest per annum. Income tax rate is 30%, and face value of one share is rupees 10. So we assume we work for a company, not an individual. We are working for a company because individual normally does not get loaned very easily, but a company can get loans very easily. So we are working from the point of view of a company only. Okay. So the face value per share is rupees 10. So there are three scenarios. First scenario is that all the amount that is required as an investment, I put this from my own pocket, that is equity, and I don't take loan from bank. Second option is that I put from my own pocket rupees 20 lakh and from bank I take 10 lakh. And third, I put 10 lakh from my pocket and take 20 lakh from bank. So in all the cases, we have to see that where we are getting EPS higher. What is EPS? EPS is earning per share. That per share, how much amount we are earning is the thing that we need to see in all the cases. So if you have one share, how much amount you are earning per share, this is what we have to calculate. So I'll just tell you what is earning per share. Earning per share is profit after tax divided by number of shares. That what profit we have earned and how much shares the company has. So it will tell you that what is the earning per share, what is the profit per share that you are getting. Okay. So let's work on these three options and see which option is better. As per the rule of financial leverage, what we have studied is that if ROI is more than interest rate, higher debt portion will give the higher EPS is the better option. Okay, let's see. Let's start. So, return on equity or profit before interest and tax. So, return on equity can also be said called as profit before interest and tax, that the profit that you have earned from the business before paying any interest and tax is this much. So, as I told you, the return on investment is 13.3333%, which is 4 lakh. So, 13.3333% is the return on investment. Total amount that we have invested is 30 lakh, because in all the cases, even if we have taken loan from the bank or we have put money from our own pocket, so the total investment in all the cases is 30 lakh only. So that means in all the three cases, that return on investment that we get from the business is 4 lakh, 4 lakh, 4 lakh. So in the case number 1, let me talk about interest first. So interest expense. So interest expense, what is the interest expense in the first case? So in the first case, we have not taken any loan from the banks. So there is no interest that we need to pay. In the second case, we have taken 10 lakh loan from the bank. That means 10 lakh into bank loan rate, which is 10%, 1 lakh, we have to pay interest to the bank. And in the second scenario, the debt is 20 lakh. That means 20 lakh, 10%, 2 lakh is the interest that we need to pay in the case number C. So that means after paying the interest, how much amount we have left. So profit before tax, this is called profit before tax. So before paying any tax, the profit is 4 lakh, 3 lakh and 2 lakh. So 4 lakh, 3 lakh and 2 lakh. Now I have to pay tax on the income. So tax rate I know is 30%. So 30% of 4 lakh. So 4 lakh 30%. So this is 1,20,000 is the tax that I need to pay in this case. 30% of 3 lakh, 90,000 will be the tax in this case. And 30% of 2 lakh, 60,000 will be the tax in this case. So that means if I say profit after tax. So profit after paying interest and tax in the first case will be 2,80,000. Okay. In the second case is going to be 2,10,000. And in the third case, it is going to be 1,40,000. So if you look at all the three options, you will say, okay, sir, first option is the better, where the equity amount is the higher, because the profit after tax is 2,80,000 and here profit is very less. But I told you that the criteria to judge is not the total profit. The criteria is earning per share, that how much amount we are earning per share. So in the first case, all the amount we have put from our own pocket. As I told you, face value of a share is 10 rupees. So that means how much number of shares are there in the first case. So there are 3 lakh shares. 30 lakh is the total amount that we have invested from our own pocket. 10 rupees is the face value per share, that means total number of shares would be 3 lakh in the first case. In second case, we have invested 20 lakh from our own pocket, divide by 10. So 2 lakh is the number of share in second case. And in the third case, we have invested 10 lakh. So 1 lakh will be the equity share holder in third case. So let me find out earning per share in all case, EPS, that is earning per share. So in the first case, number of share is 3 lakh. Amount that we have earned is 2,80,000. So 2,80,000 divided by 3 lakh. So 2,80,000 divided by 3 lakh, it is 0.933. That means per share, I am earning 0.933 in the case number 1. Case number 2, profit is 2,10,000. Number of share is 2 lakh. So 2,10,000 divide by 2 lakh. So this is 1.05 per share. That means a shareholder will get 1.05 per share. And in the third case, 1,40,000. So 1,40,000 divide by number of shares. In this case, as we said, that number of shares are 1 lakh. So that means 1.40. So that means in the third case, case number C, where we have taken more debt, we are getting the higher earning per share. That per share, we are getting a higher amount. On the other hand, if you think, okay, sir, we don't understand the concept of number of shares, please explain us through a single person. So if there is no number of shares, then explain us which option is better, because it's not the case. If you start your own business, then of course you plan to be your owner, you plan to be only owner of the business, you don't want to split the shares with anyone. So in that case, what option is better? So again, you will say, okay sir, in this case, the first option is better, because after putting 30 lakh, we are getting 2,80,000 return, which is the highest in all. Again, what you have to see if you are a single owner, listen very carefully. This is also a very important concept. After investing 30 lakh, you are getting 2,80,000 per annum. So 2,80,000 divide by 30 lakh into 100. If I say, so 2,80,000 divided by 30 lakh, it is 9.33%. So in the first case, the net return that you are getting from the business is 9.33% after tax. So normally you were getting the profit before interest and tax as 13.33%, but you have to pay tax as well. So technically you are getting 9.33% on the investment. In the second option, you have invested 20 lakh rupees and you have earned 2,10,000. So if I calculate the percentage, so 2,10,000 divided by 20 lakh into 100, it is 2,10,000 divided by 20 lakh percentage, it is getting 10.5%. So after investing 20 lakh rupees from your pocket, you are getting 10.5%. This is the loan. And on the loan, you have paid the interest. You don't have to worry about the interest part, loan part. You have invested 20 lakh from your own pocket and you are getting 2,10,000 as the profit that you will take, because you have already paid the interest. So you will get a 10.5% absolute return. And in the third case, you have invested 10 lakh and you are getting 1,40,000. So after the calculation, it is 14% return. So that means if you don't calculate from the company's point of view and you calculate from individual point of view as well. So in the third case also, where you put money from your own pocket, it is the best option. Where you take loan from the bank, and not put money from the pocket. So the best option is the third option, because after investing 10 lakh, you are getting 14% return and you still have 20 lakh in your own pocket, which you can invest anywhere else and you can get good return. We are not talking about those money. After investing 10 lakh, you are getting 14% return. So this is how financial leverage work. So this is a thing. And one more thing, guys, this is like a homework for you if you want. That is, if the return on investment of the project is less than the interest rate, so the better option would be higher equity portion. So how? So what you can do in this case? So let me give you an option or a homework if you want. So that is, rather than in the last case, what we did was the return on investment was 13.33%. So let's take an example of the return on investment is 8%. So I'm giving you that in return on investment is 8% now. So as per the financial leverage rule, the return on investment is less than the interest rate. So in this case, higher equity portion will get better return. So you have to recalculate everything if you want. If you don't trust me, you can recalculate everything and you will find out that the first option is the better option. I'm not doing it. This is your homework if you want. So what will be the profit before interest and tax? So 8% is the return. Total investment is 30 lakh. That means 2,40,000 will be the return in all the cases. Okay, so this is what your homework is. If you want, you can try, and when you'll work on it, you will see that the case number A will give you the best return from individual point of view, and also in the case if you plan for a company. So this is the term financial leverage, and as a consultant, as a financial student, and future may you will be working as a employee or as a practitioner or as a you will be starting your own business. So you can use this term financial leverage, and you can plan that rather than taking out money from your own pocket or taking money from your friend or family, you can take loan from the bank and start the business. The only thing that you have to work on is to find out the approximate return on investment. It should be correct, because if the return on investment figure is not correct, then this calculation will not work. So you have to do extensive research about the business. You have to look on different businesses who are working in the same product that you are working, and a lot of other factors. So this is called financial leverage. I hope this video helped you to understand the concept, and if you like this video, please share my channel, please subscribe to my channel if not, and please comment. So please comment if you like this video, because I'm going to start these kind of videos where I'll be explaining very important concepts for all the financial students. Okay guys, so have a good time, have an amazing Christmas and a happy new year.